By the late 1990s, a new economic logic had taken hold. Investors were trading on the belief that traditional requirements for valuing a business, like revenue, cash flow, and actual earnings, no longer applied to the internet. This chart tracks the Nasdaq Composite Index's exponential climb during that period. The line stops at the absolute peak on March 10, 2000, when the index reached 5,048.62 points. Companies with unproven business models were going public and watching their stock prices double overnight. The market was rewarding companies for their potential reach rather than their current profits. This environment created a massive collective delusion. From retail investors to institutional bankers, market participants were operating on the assumption that the internet had made the normal laws of economic gravity irrelevant. In the week of April 10, 2000, the line chart fractures. By Friday, the index suffered a 10% single-day plunge. Expanding the timeline across that 5-day block reveals the full scale, a 25% loss in total market value. Years of accumulated paper wealth began evaporating instantly. Widespread panic replaced the previous months of buying, as investors scrambled to exit positions that were losing value by the hour. The collapse was the inevitable implosion of a compromised financial engine. The mechanisms built by Wall Street to fuel the boom were now accelerating its destruction. The initial spark for this boom occurred in August 1995. When Netscape went public, its stock price more than doubled by the first day's close, proving that massive wealth could be extracted from a company that was less than 2 years old. This success shifted venture capital strategy. Instead of nurturing sustainable businesses to maturity, firms began rushing unbaked companies to the public market to capitalize on investor demand. The 1996 Telecommunications Act further deregulated the industry, unleashing billions in infrastructure spending. Companies began trenching thousands of miles of fiber optic cable based on projections that internet traffic would grow indefinitely. This cyclical flowchart illustrates a practice called circular financing. Telecom giants would lend money to their customers, who then used those loans to purchase equipment from the giants themselves, allowing the lenders to book that money as revenue. The rapid extraction of cheap capital had replaced innovation as the foundational metric of the dot-com era. Prestigious investment banks facilitated this process by abandoning standard due diligence. This allowed them to harvest massive 7% underwriting fees on hundreds of new IPOs, regardless of the company's long-term viability. This flow diagram shows how banks used IPO flipping to favor their best clients. The banks allocated hot shares to institutional investors, who immediately dumped them on the first day of trading, pocketing massive profits at the expense of retail buyers. The Friends of Frank network, associated with banker Frank Quattrone, exemplified this system. These preferential IPO allocations functioned as a form of legalized bribery, rewarding tech executives who promised to bring their future banking business to the firm. To keep the cycle moving, Wall Street analysts acted as cheerleaders on television. They were under immense pressure to issue buy ratings and avoid negative analysis that might damage their firm's lucrative banking relationships. The IPO market had transformed from a capital-raising tool into a risk transfer mechanism. It was designed to extract certain profits for insiders while leaving retail investors to hold the eventual losses. The Federal Reserve triggered the first major crack in the system. Chairman Alan Greenspan began raising interest rates to cool the overheated stock market, making the cheap capital that fueled the dot-coms suddenly expensive. At the same time, massive insider stock lockups expired. Founders and early employees, who knew the precarious state of their companies, began cashing out. This bar chart shows how the resulting influx of shares flooded the market, overwhelming buyer demand. Morphing into a scale reveals a fatal flaw. Acquiring a single customer cost $80, while that customer's lifetime value was only $10. The bubble popped because the market ran out of greater fools to fund these unsustainable losses. When the inflow of fresh capital stopped, the companies began to fold. Tracking the market from March 2000 to October 2002 dispels the myth of a single quick crash. Instead, it was a grinding 2.5-year bleed-out. Every brief rally triggered heavier selling, until the Nasdaq hit absolute bottom at 1,100 points, a catastrophic 78% total loss. The destruction of retail wealth was almost total in some sectors. Companies like Pets.com, once symbols of the new economy, saw their valuations drop over 99% before closing their doors forever. As the tide of capital retreated, it exposed massive systemic frauds. Corporations like Enron and WorldCom, which used aggressive accounting to hide losses and inflate their stock, completely collapsed under the weight of their own deception. The evaporation of $5 trillion in market value decimated retirement accounts, leaving millions of retail portfolios with losses taking years to resolve. Despite the financial ruin, the billions wasted by Wall Street left behind a robust physical infrastructure. The server networks and fiber optic cables installed during the mania survived the crash. This infrastructure eventually powered a genuine digital revolution, funded by a systemic wealth transfer that proved basic economic laws cannot be ignored.
Coiled spring strategy. Profit from volatility before the market breaks.